Happy Friday. Between headlines about sticky inflation and the market reaching new all-time highs, it can feel like you should be doing something with your money right now. Before you head into the weekend, I want to share why, for many long-term investors, the most productive move is often staying patient, assuming you have a plan in the first place with someone you trust, and how a shift in perspective might even lead to a higher return on life. This week's inflation data confirmed what many of us are already feeling. At the grocery store or when paying for services, prices are still elevated. Headline inflation rose 0.6% in April, bringing the 12-month increase to 3.7%. But for long-term planning, we tend to focus more on core inflation, which excludes food and energy and reflects more stable categories like housing and services. And in April, shelter costs increased again, reinforcing something important. Some parts of inflation tend to be persistent, not temporary. What this means for your plan. For your retirement, your back nine, these higher costs can represent a lasting increase in your future lifestyle expenses. That's one of the reasons we do not rely solely on cash for long-term planning. Can Cash can lose purchasing power over time in an inflationary environment. Instead, a diversified growth-oriented portfolio is designed to include companies that, over time, have been able to adjust prices and grow revenues, helping investors keep pace with rising costs. Let's talk about the market. Historically, the stock market has averaged around 10% annually over long periods, but in any given year, returns can vary significantly. Just looking at the past few years, 2025, it was up about 18%, and we say the market, we're talking about the S&P 500. 2024, it was up about 23%. 2023, it was up about 24%. In 2022, it was down about 19%. That long-term average is not something investors experience evenly. It's the result of staying invested through both strong years and challenging ones. Key idea: historically, long-term results have tended to reward investors who remain disciplined and invested over time. With markets performing well recently, it's natural to hear questions like, should I take some gains off the table? Are things too high right now? Those are questions are reasonable. But strategies like buy low and sell high depend on being able to accurately identify both when to exit and when to re-enter the market, something that is very difficult to do consistently. Every market high we've seen historically has eventually been followed by new highs, although the timing is always uncertain. The other side of the challenge. During market declines, the instinct is often to step aside and wait for things to stabilize. However, historically, some of the strongest market recoveries have occurred shortly after significant downturns. For example, during the market volatility in spring 2025, markets declined sharply and then rebounded substantially later in the year, and we saw similar actions with that this year. Investors who moved to the sidelines during that period may have missed part of that recovery. Another consideration: when you step out of the market, you're also stepping away from dividends that pay you while you own those equities, reinvestment, and compounding over time. Those are key drivers of long-term portfolio growth. Bottom line, rather than trying to outguess the market, many investors benefit from focusing on a disciplined, long-term approach aligned with their goals and risk tolerance. Let's shift gears from a moment to the back nine life. A trend we're seeing more of in 2026 is the move from fast-paced travel to what's being called the slowcation. Instead of visiting multiple cities in a short period of time, many retirees are choosing to spend several weeks in one location. Why the shift? Depth over speed. Rather than rushing, you get to experience a place more fully, finding your favorite spots and settling into a routine. The journey matters. Rail travel, in particular, has become more popular as people embrace a more relaxed pace and better overall experience. The goal becomes coming back feeling refreshed. The goal becomes coming back feeling refreshed, not exhausted from trying to fit in everything. The back nine is really about having the time and flexibility to enjoy life at your own pace, and this is a great example of that. That's it for this week. As always, the goal here is to provide helpful perspective, not to make short-term predictions or specific recommendations. Just a quick reminder, this content is for informational purposes only and should not be considered personalized investment advice. All investing involves risk, including the potential loss of principal, and past performance does not guarantee future results. If you find these updates helpful, please be sure to follow the page so you don't miss future videos. Drop a comment with any questions or topics you'd like me to cover next. And if you think it might make sense to have a conversation about your own plan, you're always welcome to reach out and schedule a meeting. Thanks and have a great weekend. Bye.